Investing can often feel like navigating a labyrinth, filled with choices that can leave even the most seasoned investors scratching their heads. Among the myriad of options available, two primary approaches stand out: index funds and actively managed funds. Each has its own merits, drawbacks, and philosophies, and deciding between them can significantly impact your financial future. To make an informed decision, it is essential to delve into the characteristics, advantages, and disadvantages of both investment types. Index funds are designed to mimic the performance of a specific market index, such as the S&P 500. They achieve this by holding the same stocks in the same proportions as the index they track. The primary appeal of index funds lies in their simplicity and low cost. By investing in an index fund, you are essentially buying a small piece of a broad market, which provides instant diversification. This diversification is crucial because it reduces the risk associated with investing in individual stocks. If one stock in the index underperforms, the overall impact on your investment is minimized by the performance of other stocks. One of the most compelling arguments for index funds is their cost-effectiveness. Actively managed funds typically charge higher fees because they employ teams of analysts and fund managers who make decisions about which securities to buy and sell. These management fees can erode your returns over time. In contrast, index funds have lower expense ratios, as they require less active management. This cost advantage can be significant, especially over the long term, where even a modest difference in fees can compound into a substantial amount of money. Moreover, research consistently shows that most actively managed funds fail to outperform their benchmark indices over the long term. A study by S&P Dow Jones Indices revealed that over a 10-year period, nearly 90% of actively managed funds underperformed their benchmarks. This statistic raises a critical question. If most active managers cannot consistently beat the market, why pay higher fees for the chance of underperformance? Index funds, on the other hand, guarantee that you will achieve market returns, which historically have been positive over the long haul. However, it is essential to recognize that investing in index funds does not come without its challenges. One of the criticisms of index funds is that they are inherently passive and do not allow for the potential of higher returns that can come from active management. While it is true that index funds aim to match market performance, some investors are drawn to the allure of outperforming the market. They believe that through diligent research and strategic decision-making, a skilled fund manager can identify undervalued stocks or sectors poised for growth. This desire for alpha, excess return above the benchmark, drives many to consider actively managed funds. Actively managed funds offer the promise of potentially higher returns through expert analysis and decision-making. Fund managers typically have access to extensive research, tools, and resources that individual investors may not possess. They can react to market changes, economic indicators, and geopolitical events in real time, adjusting their portfolios to capitalize on emerging opportunities. This level of responsiveness can be particularly appealing during periods of market volatility, where a skilled manager might navigate the turbulence better than a passive strategy would. Additionally, actively managed funds often focus on specific sectors or investment styles, allowing investors to target areas they believe will outperform the broader market. For example, an actively managed fund might concentrate on technology stocks, emerging markets, or value investing. This targeted approach can be attractive to investors who have strong convictions about certain sectors or trends and want to leverage those insights for potentially higher returns. Yet despite these potential advantages, actively managed funds come with significant drawbacks. The higher fees associated with these funds can be a double-edged sword. While investors may hope for higher returns, the reality is that these fees can significantly eat into profits. Furthermore, the performance of actively managed funds can be inconsistent. A fund that outperforms one year might lag behind the index the next, leaving investors vulnerable to the whims of market conditions and managerial decisions. Another consideration is the emotional aspect of investing. Actively managed funds can lead to a more hands-on approach, where investors may feel compelled to monitor their investments closely, leading to anxiety and impulsive decision-making. In contrast, index funds, with their buy-and-hold strategy, encourage a more disciplined investment approach, which can be beneficial for long-term wealth accumulation. When weighing the decision between index funds and actively managed funds, it is crucial to consider your investment goals, risk tolerance, and investment horizon. For those who prioritize low costs, broad market exposure, and a passive investment strategy, index funds may be the ideal choice. They are particularly well-suited for long-term investors who believe in the overall growth of the market and wish to avoid the stress of active management. On the other hand, if you are an investor who enjoys researching stocks, has a high risk tolerance, and believes in the potential for active management to deliver superior returns, actively managed funds might align more closely with your investment philosophy. However, it is essential to approach this option with caution, recognizing that past performance is not indicative of future results. Another factor to consider is the current market environment. In bull markets, index funds often shine as they capture the upward momentum of the broader market. Conversely, during bear markets or periods of economic uncertainty, actively managed funds may have the advantage of being able to pivot and adjust their strategies to protect capital. Understanding the market cycle and how it may impact your investment choices can provide valuable insight into which approach might be more suitable at any given time. Diversification can also play a pivotal role in your decision. Many investors opt for a combination of both index and actively managed funds within their portfolios. This hybrid approach allows them to benefit from the low-cost, passive nature of index funds, while also having the opportunity for higher returns through select, actively managed investments. By striking a balance, investors can achieve a well-rounded portfolio that aligns with their financial goals and risk tolerance. Ultimately, the decision between index funds and actively managed funds is not a one-size-fits-all answer. It requires careful consideration of your financial situation, investment objectives, and personal preferences. As the investment landscape continues to evolve, staying informed about trends, performance metrics, and economic indicators will empower you to make the best choices for your portfolio. In conclusion, both index funds and actively managed funds have their place in the investment world. Index funds offer a straightforward, cost-effective way to gain exposure to the market and achieve consistent returns over time. They are ideal for investors seeking simplicity and long-term growth without the stress of active management. On the other hand, actively managed funds provide the potential for higher returns through expert analysis and strategic decision-making, appealing to those willing to take on more risk and pay higher fees for the chance of outperformance. As you contemplate your investment strategy, consider your unique circumstances and priorities. Whether you choose to go with the passive approach of index funds, the active strategy of managed funds, or a blend of both, the key is to remain committed to your investment plan and stay focused on your long-term financial goals. In the end, successful investing is not just about the choices you make, but also about your discipline, patience, and ability to adapt to changing market conditions.